We're going to talk about why interest rates are not going to drop as fast as you think. Some reasons will surprise you, others will just make sense because as end users, we always get screwed by both the banks and everybody else. But the Fed cut interest rates back in September, and then once or two more times since then. But rates have continued to go up because they're based on the 10-year Treasury. And now other things affect the 10-year Treasury besides just what the Fed does. So, like recently with the introduction of potential tariffs, especially with China, China holds a lot of our debt. And if they stop buying it or they sell it, that actually causes our 10-year Treasury to rise, which is what I think we saw the other day when the rates went from mid fives into the sevens. Because if they start unloading that debt, it's going to affect our 10-year Treasury. So even if the Fed lowers rates again, it's not going to make much of a difference because it's going to just go off that 10-year Treasury. And that's number one, when it comes to what could possibly happen, why they're going to go slow. Number two, banks like to make money. The Fed lowers their costs with those interest rate cuts, but your cost to borrow has gone up. So the spread has now changed. So the banks are making more money within the last 6 months than they did prior to the 6 months because they have a bigger spread. So they're in no rush to let that equalize. I'm sure they actually like this 10-year Treasury spread. So any further increases in the 10-year, they're just going to catch even more of it because they're still borrowing at that cost. That doesn't change on their end. They're just charging you that middle difference. And the third reason, a little less known, is what they call EPOs, which is early payoffs. If you buy a house, you start a mortgage, and then within 6 months you close it, whether you sell it or refinance, there's really like a clawback of fees because there's upfront costs that aren't covered that take time to play out. So if they start a loan with 7%, a month and a half ago, and then it's down to 5.5%, if they drop it too fast, they're worried that someone they just gave that rate to is going to refinance, and they're going to be an early payoff. So intentionally, they're also going to keep that spread somewhat wide because they're going to lose their loan, they're going to lose their loan servicing, it goes to another lender, and they kind of lost money on that deal. So 3 reasons why it's going to just be a slower rundown than you think because there's just so many other factors that go into it. But hang tight, keep you posted as more goes on.